Hi, this is Karaoke Andy, and today I want to give you an introduction to a profitable trading edge and proper risk management. So in this video I'm going to show you the elements of an edge, why focusing on high probability setups is not necessarily making you any money, why you are probably risking too much per trade, and how you should apply this approach to risk when trading with a prop firm. Let's get right into it. I feel compelled to do this video because there are far too many social media posts of fake gurus who promote a win rate of 90%. Those who tell you to sit there and wait for the A+ setup. You've all read those posts, right? And that is of course nonsense. Ladies and gentlemen, there are three elements to every profitable edge. First is probability of the setup occurring. Let's call it win rate. Second is risk to reward ratio, and I will talk about that extensively in a minute. And the third is commission. It's often forgotten. The costs of trading. If you scalp the 30-second chart, you have to be very good at it because every time you press that button, you have to pay commissions to your broker. So, now let's assume you flip a coin, with heads and tails. So if you flip that coin often enough, you get an outcome of what? 50% heads and 50% tail. 50% heads and 50% tails. If you bet on heads only, you will win 50% of the time. But you will also lose 50% of the time. Will that make you a break-even trader? No, because you still have to pay commissions on every trade. So you will lose money on that system. Now let's imagine a different game. Now we're tossing that same coin and heads will be a long position and tails will be a short position. And before I throw that coin, you would have to pick either heads or tails and bet on it. And when you are right, you would get double the amount of money that you bet. And when you are wrong, well, you're just losing the amount that you bet. Would you play that game? I believe you do, because you would have an equivalent of a system that returns, on average, twice the amount of money that you bet 50% of the time. If you have a system like that, you have it bloody made. So what just changed to the first example where you would break even but actually lose money because you have to pay commissions to the broker? What changed now is that we introduced a risk to reward ratio of 2:1. And that's the second element of a profitable edge, the risk to reward ratio. When you're right, you make twice as much as you risk. In this example. So suddenly you have a profitable edge. Now, I'm asking you, how much do you bet? It would be very compelling to bet a lot, right? Now, in this can here, there are 100 coins. That is your account size. So how much do you bet for a trade in this winning system? Before I throw that coin, how much would you bet? Would you bet 1 coin, 5 coins, 50 coins? Would you bet everything? Now here's the thing that you need to understand. If you bet 25 coins, every 16 trades you will go bankrupt. I repeat, every 16 trades you will go bankrupt. Because statistically, every 16 trades in a system with a 50% win rate, you will get 4 losers in a row. Far too many people risk far too much per one trade. If you are new to this, what you should be risking is 1%, maybe 2%, but not more on each and every trade. 1%, maybe 2%. That would be a conservative approach to risk management, because that would allow you to sustain a series of losses that will statistically and inevitably happen. Keep in mind, we're not even talking about real market conditions here. We're just talking about a coin game that represents a trading system. Again, in this example, we are imagining a trading system that returns twice as much as you risk. 50% of the time. So we have a win rate of 50% and a risk to reward ratio of 2 to 1. It's a winning system, but you can't risk more than 1 or 2% per trade. Otherwise, you go bankrupt. Now, unfortunately, a lot of you guys trade with prop firms. And if you trade with a prop firm, you have to approach this differently. If you have a 50,000 euro prop firm account, you can't base the 1% risk on the account size. Depending on the rules of each prop firm, you have to base that on something else. So if you're trading, for example, with FTMO, you have a 10% maximum drawdown. That would be 5,000 euros in this example. And that's what you would have to base your risk on. 1% of 5,000 euros is 50 euros. 2% is 100 euros. Do you understand that? If you risk more than that, you will likely lose your account. Not because your edge is not working, not because you're a bad trader, just because your risk management is off. Now that you hopefully understand that, do you see now how ridiculous it sounds when the fake gurus are just talking about win rate and their A+ setups? Because they completely leave out the other two elements of a profitable edge: risk to reward ratio and commissions. Now, I've been around long enough to assure you that there is no such thing as a profitable system out there that has a 90% win rate. Doesn't exist. And the emphasis here is on profitable. Right? At this point, I want to ask you, are you trading to be right, or are you trading to make money? Because if you want to be right, then forget about everything that I say here. But if you want to make money, don't be fooled by a high win rate, but focus on risk to reward. If the risk to reward ratio is in your favor, you don't need to be right 90% of the time. You don't even need to be right 50% of the time. There are profitable systems out there that have a win rate of 20%. An example for a system with a low win rate but very high risk to reward is turtle trading. So, and I know you guys think of ICT and turtle soup, forget about that. That's not what I'm talking about. I talk about the infamous turtle traders from the 1980s. Go look it up, it's worth a read. But of course, the lower the win rate is, the higher the probability that you have losers in a row that you need to sustain psychologically. Imagine having 4 losers in a row and you still need to put on the next trade without fear or hesitation. That's what real trading is about. But what do the fake gurus do? They promote a flashy 90% win rate instead. Okay, let's entertain that idea for a second. How do you get a 90% win rate with any system? Let me give you an example from a different industry. I had a career in the German retail industry, and before I traded full-time, I was a freelance consultant in the area of e-commerce. What online shops are obsessed with is conversion rate. The conversion rate is the percentage of visitors of an online shop that actually buy something. And you want that number high. But it's pretty easy to understand that you can manipulate that number to be close to 100% if you just start selling everything for 1 cent or maybe even for free. Sell everything for free, and that at that price everybody will buy. Does that make sense? So a high conversion rate does not say anything about the profitability of an online shop. Back to trading. The equivalent of the conversion rate in trading is, you guessed it, the win rate of an edge. And if you want that number high, what are you going to do? You just increase your stop loss indefinitely. Yeah? So you never get stopped out. And you always will be right. Unless you do get stopped out and then the loss is too big to sustain and you blow up. Gone. That's why focusing on a high win rate alone is nonsense, ladies and gentlemen. I repeat, the elements of a profitable edge are win rate, risk to reward, and commissions. I hope that makes sense. Karaoke Andy, out.